Assalamualaikum everyone. So we are from Group 2, consisting of myself, Arif Najmi, alongside my teammates, AFIF AZIZI, AKIF MUAMMAR and AZFARIS HAIKAL. So today we will be presenting our financial reporting 1 assignment, SCC 1170. So let's jump to the introduction. For the introduction, Buat Bersendiri yang Berhad is a Malaysian incorporated medium-sized enterprise. The company specializes in manufacturing and selling building materials, specifically cement-based wall panels and floor tiles, and operates a small trading division for imported adhesive compound. For the financial year ended 31st December 2025, the company's accountant, Ms. Lina, raised several critical queries regarding how to value and report this item. To resolve this, our evaluation strictly complies with the guidelines of MFRS 102 inventories. So now I will now pass the floor to Afif Azir to discuss the initial measurement.
So today we will be presenting question 1, which focuses on the initial measurement of inventories under MFRS 102. So let's start with the cost of purchase. On 1 March 2025, Brightwood purchased 10,000 kilograms of cement powder at RM4.50 per kilogram, giving a total purchase price of 55,000 ringgit. To determine the inventory cost, we also need to include costs that are directly related to acquiring and transporting the inventory. This includes import duties of 6,000 ringgit and freight in cost of 4,500 ringgit. However, the trade discount of 3,000 ringgit must be deducted because MFRS 102 states that trade discounts reduce the purchase cost of inventories. After making these adjustments, the total cost of purchase is 52,500 ringgit. There are also several costs that should not be included in inventory costs. These are the settlement discount, animal wastage during unloading, storage costs after the goods reach the warehouse, and general administrative overheads. Since these costs do not contribute to bringing the inventories to their present location and condition, they are recognized as expenses instead. So next, let's look at the cost on conversion. During production, Brightwood incurred fixed production overheads amounted to 30,000 ringgit according to MFRS 102. Fixed overheads should be allocated based on normal production capacity, which is 5,000 units. To calculate the absorption rate, we divide 30,000 ringgit by 5,000 units, resulting in 6 ringgit per unit. Since actual production was only 4,000 units, the amount of fixed overhead absorbed into inventory is 24,000 ringgit. This leaves 6,000 ringgit as underabsorbed. Under MFRS 102, since actual production 4,000 units is lower than normal capacity 5,000 units, MFRS 102 requires the overhead rate to be based on normal capacity. The allocated overhead of 6,000 ringgit should not be included in inventory cost and must be recognized as an expense in the statement of profit or loss for the year. So next, I will pass to Arif.
Thank you. So thank you, Afif. So now let's look at how Brightwood evaluates its closing inventory at 31st December 2025 using NRV. So for the sake, let's review the items item by item. For cement powder, the cost is 38,000 ringgit, and the NRV is 39 and 100 ringgit. Since the cost is lower, it remains valued of 38,000 ringgit. So for wall panels, the cost is 95 and 400 ringgit, but the NRV drops to 92,500 ringgit. So we must write it down to its NRV, resulting in a write-down amount of 2,900 ringgit. So for the imported adhesive compound, show a heavy drop. The cost is 22 and 500,000 ringgit, but the NRV is only 18,100 ringgit. This requires a write-down of 4,400 ringgit. Lastly, for the floor tiles, have a cost of 31,000 ringgit and an NRV of 27,400 ringgit, requiring a write-down of 3,600 ringgit. So in conclusion, the total value of ending inventories reported on the balance sheet will be 176,000 ringgit, and the total inventory write-down loss comes to 10,900 ringgit. So to account for this loss, we have prepared the necessary year-end journal entry on 31st December 2025. So we debit cost of goods sold for 10,900 ringgit and credit ending inventory for 10,900 ringgit. By debiting cost of goods sold COGS for 10,900 ringgit, the company recognized this loss as an expense in the current financial year, which increases total operating costs and ultimately reduces Brightwood's reported gross profit for 2035. Simultaneously, crediting ending inventory for 10,900 ringgit directly reduces the asset value on the balance sheet, ensuring that the final inventory is accurately reported and leads to net usable value of 176,000 ringgit. rather than its inflated historical cost. And also, Miss Lina also asked whether she could group these inventory items together when performing this assessment. Our strong advice is to her is no. She must continue using an item by item basis. Why? Because white bill deals with distinct manufactured building materials like panels and tiles, alongside entirely separate imported branded products. If we group them together, the profits from stronger items would inappropriately offset and hide the losses of the declining item. Testing item by item ensures prudence and transparency. Next, AZFARIS will walk us through the recognition of inventories as expenses.
Thank you, Arif. So next I will explain about the third task, which is recognition of inventory as expense. So the first question, explain when the cost of inventory is recognized as an expense under MFRS 102 with reference to the relevant paragraph. So according to MFRS 102 paragraph 34, the carrying amount of inventory is recognized as an expense in the same period when the related revenue is recognized. This expense is commonly known as the cost of goods sold or COGS. The purpose of this requirement is to ensure that the cost of inventory is matched with the revenue generated from its sale. In addition, any inventory write down to net realizable value and any inventory losses must also be recognized as an expense when they occur. Therefore, inventories are recognized as an expense when the related revenue from their sale is recognized. So the next question, Brad built Surya Berhad sold 500 walls panels to Data Build Sendirian Berhad on credit for 110,000. The panels were delivered and legal title was transferred on 28 November 2025. Although payment will be received in February 2026. Revenue should be recognized in the financial year ended 31st December 2025 because the goods were delivered and ownership was transferred before year end under the accrual basis of accounting. Revenue is recognized when it is earned rather than when cash is received. Therefore, Bright Bill should recognize revenue of 110,000 in the financial year ended 31st December 2025. In relation to the cost of goods sold, the cost of the 500 wall panels is 78,000 under MFRS 102. The carrying amount of inventories sold must be recognized as an expense in the same period as the related revenue. Since the revenue is recognized in the financial year ended 31st December 2025, the corresponding cost of 78,000 should also be recognized as cost of goods sold in the same financial year. So next, I will pass to the AKIF MUAMMAR.
So thank you, As. So now we will look at how Brightview should handle 200 wall panels held on consignment by Mega Retail SDN HD as of December 31, 2025. The core question we need to answer is, should these panels be included in Brightview's closing inventory? Let's break down the answer into three simple parts. So number one, consignment inventory. As of December 31, 2025, these 200 wall panels are physically sitting at Mega Retail. However, under a consignment arrangement, Mega Retail is simply acting as the consignee, meaning they are just trying to sell the goods on behalf of Brightbuild. Crucially, Brightbuild only gets paid after Mega Retail successfully sells those panels to end customers. So number two, ownership and control. In accounting, physical location does not equal ownership because these 200 panels have not been sold to end customers yet. The risk, rewards, and legal ownership of the inventory remain entirely with Brightbuild. Therefore, Brightbuild still retain full control over this asset. So for the last point, accounting treatment and conclusion. Finally, what is the correct accounting treatment at year end? Because no actual sale to an end consumer has happened, Brightbuild must follow these three rules. Number one, no revenue should be recognized. Number two, no cost of goods sold should be recorded. Last,
And to answer our main question, yes, the 200 wall panels must continue to be included as closing inventory in Whitebuild's financial statement. So that's all from us. Thank you.